All right, so here's my June 2019 stock market income report. So if you've watched my previous videos, you know that my strategy is mostly writing covered calls or selling options. So the only income that I would get from the stock market is from call premiums that I'm selling or option premiums that I'm selling, and some dividends. When I'm writing covered calls, I end up holding the stock. So if I'm holding the stock before X dividend date, then I end up collecting a dividend as well. But I don't buy and sell a stock for a profit. So my only source of income from the stock market is dividends and option premium selling. All right, so if we look at the option premium selling first. So for the month of June, for American Airlines, I bought and sold covered calls on American Airlines several times. So for American Airlines combined, I've collected about $127 Canadian. For ACB, so Aurora Cannabis, collected $31 Canadian. For Bed Bath & Beyond, collected $19 Canadian. So these, of course, are after commission. So this is net. For Bristol Myers, collected $23 Canadian. For Box, I collected $55 Canadian. For Crescent Point Energy, collected $73 Canadian. Now for gold ETF, this is an Iron Condor. Collected about $58 Canadian, but this isn't confirmed yet because the trade is still open. I still have to close it by July 19, and the only way I make max profit is if the ETF actually stays between a certain range. So this is not confirmed yet, but this is what I collected up front, and this is the max profit I can get from this Iron Condor. Halliburton collected $72 Canadian. IMGN collected $42 Canadian. Kraft Heinz collected $57 Canadian. Kroger collected $173 Canadian. L Brand collected $37 Canadian. So these are just from selling options against the stock that I'm holding. Now the stock itself could be down, but I'm still selling call options against these stocks, so therefore I'm collecting an income from them, even though the stock itself could be down 5 or 10%. Macy's collected $18, actually a bit more. So Macy's collected $46. Mattel collected $31. Micron collected $312 Canadian. Netflix is an Iron Condor that just opened up, so it's not confirmed yet. Collected $141 Canadian, but as you can see, for me to keep all of it, Netflix needs to stay between $320 and $415 come July 19 expiry date. So most likely I'm going to try to close this trade before July 19 because they have earnings, I believe, on July 19. Usually after earnings there's definitely a lot of movement, so don't want to take the risk. So we'll try to close this trade before July 19. So if I collected $141 Canadian, I could probably close it out for maybe $40. So I'll keep the difference maybe of $100. We'll see. As you can see, Netflix has to stay within that range between $320 and $415. Collected $453 from Nvidia. So if you've watched my previous video, this was actually done in 1 week only. So this was a pretty good one, and I got my money back. So $453 from Nvidia. Sprint, about $259 Canadian. Six Flags, about $78 Canadian. SPX was an Iron Condor that I made several adjustments to, and I ended up losing money at the end because I made adjustments early. As you can see, all this here, all this is SPX. So I made several adjustments. When I initially placed the trade, I had a very wide range, but then when the market dropped hard in May, I brought down the call side closer, but then the market went back up in June. So my call side got tested and breached, so I had to close out the trade several times and make adjustments. So at the end, so I started off by profiting $125, I believe, but at the end I lost $159 Canadian. So it's better than max loss. Max loss on this trade would have been $375. I ended up just losing $159 Canadian. Iron Condors is still a learning process for me, but definitely if I can learn something from this trade is that I made an adjustment early. I still had a lot of time left before expiry date, and I played with the call side too early. I brought it in closer when I shouldn't have. If I didn't bring it in closer, I would have made my max profit of $125 US without having to make all these adjustments and pay all the commissions every time I made adjustments. So the mistake here was being, I guess, impatient and just wanting to make trades. All right, so after that, I've got several iron condors on SPY, but before the iron condors, I've got a covered call that I sold on the SPY ETF. So the ETF that tracks the S&P 500. I collected $229 Canadian from the ETF, and then from the iron condors, which haven't expired yet, so it's not confirmed yet, but for now I'm sitting on a profit of $228 Canadian from selling iron condors on the SPY. And then Square, I've got all this on Square for the month of June, so collected about $382 Canadian from Square, which is a $7,500 investment. So I've got a Tesla iron condor that I just put on this week, expires July 19. I collected from that $111 Canadian, and for me to keep all that $111, Tesla needs to stay between 185 and 270 between now and July 19. I've got a covered call on USO, collected $125, and this one I sold. I closed it early, so I got my money back. Western Digital collected $76. I could have collected more on this one actually. When Micron went up after earnings, Western Digital went up as well, and I would have collected a much higher premium. I think I could have collected like $200 instead of $76. But yeah, what are you gonna do? I don't want to. I'm trying to find a way that's more mechanical. I don't want to start predicting and guessing and anticipating. I just want to be mechanical about this. So as soon as the old options expired, I immediately sold other ones. I didn't necessarily want to wait, because who knows, it could have dropped after Micron. So then I would regret even more not selling something earlier to collect at least $76 than an even lower amount. So I don't want to play the guessing game or the waiting game or the predicting game. So whatever, collected $76, and it expires July 19, and it looks like Western Digital will finish above my strike price of 47, so I'll get my money back as well on that one. So Weight Watchers was a pretty bad trade I've had for a while now. I bought it at 30, and then in the first month I sold a call option at a 27.5 strike. So I gave myself some downside protection, but the stock went all the way down to 18. And since then I've been selling call options at a 25 strike, because of course at a $30 strike I would not collect any premium. So this is at a 25 strike, and I even had to go all the way out to August. So collecting $57 on that one, Weight Watchers. And then United States Steel, expiring July 19, 18 strike, collected $21. And then Yeti collected $57. So these are all my covered call trades and some iron condors, as you could see, for the month of June. So the total premiums collected just from selling options is $3,229 Canadian. And I've got about $140,000 in capital that's being used to generate this right now. And now if you look at the dividends collected for the month of June, so call premium is about $32.30. And now if we look at the dividends, so the dividends for the month of June in Canadian, $39 from L Brands, $11 from Honda, $40 from Ford, $90 from Kraft Heinz, $22 from United States Steel, $92 from Six Flags, and then from the financial 15 split and the dividend 15 split from Quadravest, which is a monthly dividend, collected a total of $33. So in total dividends, that's about $330. So combine that to the option premiums I sold or collected, $32.30 plus $330, I believe, yeah. And this is after commission, so it's about $35.60 in income, I guess, I collected from my stocks for the month of June. So I've got about $140,000 that's used up. So that's about 2.5% per month for the month of June. actually, to be fair, I should remove the interest that was charged on my margin account. So it's about $700 in interest that was charged in my margin account, because I'm basically using probably around $80,000 in margin. So 3560 minus $700 Canadian, so I'm left with 2860 divided by 140,000. So I'm down to 2% per month. So per year, of course, that's about 24% if I can remain consistent. I mean, I've had better months actually. I've had a month, I think the month of April, I collected $7,000 in call premiums, and with even less capital. But but the market was generally going up, so every time I sold a call premium, it was always the highest call premium I can collect. Most of the call premiums I sold in June were very far out of the money because my stocks actually dropped far from my initial cost, so the premiums collected were much lower. So hopefully in July, if the stock market goes higher, most of my stocks will be closer to my cost and my premiums will be higher. So for example, American Airlines, this is a stock that hasn't dropped much, so it's close to my cost. ACB has dropped a lot, so I bought it at 10, but I think it was trading at 7.5, so that's why premiums are very low. Bed Bath & Beyond, I bought it at 16.5, and the stock is trading at 11 or 12, so that's why the premiums were low. Bristol Myers, same thing, I bought it at 50, stock is trading at around 45, so that's why premiums were low. Box, same thing, bought it at 20, stock was trading at 17.5, that's why premiums were low. Crescent Point Energy, that's a new stock, so it's a high premium because I sold it exactly at the money, so at the price that I bought it at, so this is fair. This is an iron condor trade. Halliburton is considered high because I just bought it and sold it at the money. IMGen is obviously very low. I'm down like 70% on the stock. Kraft Heinz is also pretty low, bought it at 36 average price, stock is trading at 31. Kroger, the first call premium I collected on Kroger is high because it was at the money and it was actually just for 1 week. But then after earnings, the stock dropped to 22, even 21. So the premiums, the second for the following month is only $45, actually even less, $37. So as you can see, for just 1 week, the call premium I collected was $135. But then for the following whole month, collected $37. So you see the big difference? That's because the stock dropped from 24 to 22, and I have to stick with the 24 strike price because remember, the consequence of writing covered calls or selling call options against your stock is if the stock price ends up above your strike price come expiry date, your shares will get sold at that price. So if I have to keep a 24 strike because that's what I bought it at, and I don't want to sell my stock, of course, below 24. So I can't pick a 20. So when the stock drops to 22, I can't sell a call option at a 22 strike price so that the premium is higher, because I have the risk of losing my shares at 22 and losing $2 per share, which is not what I want. L Brand was pretty low as well because the stock dropped. Macy's was very low because the stock dropped. Mattel was low because the stock dropped, but then it went up right after I sold it. So if I just waited a few days, I would have collected a higher premium. Micron, one of them is actually pretty low. So this one's high. This one I sold. This one was just for 1 week as well, and this one was sold at the money. So this is relatively a high premium. This one here is pretty low. This is for 200 shares. This is actually for 100 shares, and this is for 200 shares, and it's less than the one I sold for 100 shares, and it's actually for 1 month out. While this one was just 1 week. So you can see what happens when you sell a call option after the stock drops hard. Netflix is an iron condor. Nvidia was pretty good, of course. This was sold at the money, and this is just 1 week. Sprint as well is pretty good. Six Flags is kind of weak because the stock was trading at around 49 when I sold this premium, but I bought the stock at 54. And the SPY is also very good, of course. This is just in 2 days actually. This $229. This expires July 1st. I sold this on Friday and expires on Monday, so I guess that's 1 day. So this is a good one. Square is not bad. I mean, it's just the 116 is just for a week, 187 just 1 week, 137 also 1 week. So it's not bad, can't complain. USO is a good one as well. Western Digital was a very bad one. See, my average cost was 47, but when I sold that call option, the stock was trading at 41. So of course the premium was much lower. Weight Watchers, of course, is low. United States Steel is low as well. My average cost is 18, but the stock was trading at 15. And then Yeti as well was low. My average cost is 33 and a half, but the stock was trading at 28. So as you can see, there were a lot of low premiums. So maybe when the stock market recovers a bit, the premiums will go back to what they were in April. So even with the $700 of interest from the margin account, I was still able to make or to have a profitable month and profitable income, positive cash flow. So if you have any questions, leave them in the comment section below. Don't forget to check out the referral links in the description below the video. Thanks for watching.